I'm going to talk about where to look for hidden profits, and I'll explain in a minute what I mean. First, just a brief introduction. So that's a much younger version of me up there. You know, I just had to save a little bit of funds by not taking a new picture. Plus, I'm not getting any better with age in that respect. But I spent 15 years at large firms, and 2 years ago I decided to strike on my own and start my own value partnership, with the goal really being to, be able to achieve the alignment that was very difficult to achieve for me at large firms. A little bit about silvering value partners. Alignment is very important. I have a lot of passion for the business. I know a lot of us probably feel the same way. That we love looking for investments, finding ideas, understanding companies. Competence, I'll let you judge for yourself. Times people ask, what is your competitive advantage? Because it's a question I like to ask CEOs of companies that I invest with. And I wish I had one big thing. A friend of mine said it'd be great if you had a satellite that could look into the factories of the companies you're investing in just to see how demand's going. I don't have a satellite like that, and as a long-term investor, I'm not sure that would help me anyway. I think it's a combination of things. For most value investors, long-term time horizon is a component of the advantage. It is for me as well. In my case, I think it's easy to say you have a long-term time horizon. I think it's important to actually set yourself up structurally to be able to actually have it. And in practice, that means having the right partners, the right limited partners who actually are going to be providers of capital when the opportunity set is attractive, as opposed to being cyclical like most investors are. I think of myself as a microeconomic expert. I have no opinion about the Fed or Trump or other things, meaning I might have private opinions, but that's not what informs my investment decisions. I really look for company and industry specific situations where I think I have an advantage. Limited asset base is important. I think that you can achieve much better results over time if you are able to invest in much more inefficient parts of the market, which once you go beyond a certain point in assets, you can no longer really do effectively. And then temperament. That's probably the hardest to prove, but it's probably the most important. I think some people are just wired to remain rational, and I think Charlie Munger said this well 2 years ago at the Berkshire Hathaway annual meeting, and I think the quote is something like, many people try to be brilliant, and we just try to stay rational, and that's a big advantage. So I think that's something that I try to do well. I have an intrinsic value approach. The partnership is concentrated in 10 to 20 investments, closer to 10 most of the time. It's really about a long-term process. There's definitely a quality bias to my approach, and also a margin of safety demanded in terms of price. So today, as I promised, I'm going to talk about where to search for hidden profits. And it's a question I've been struggling with because over the last couple of years, my ability to find attractive investments has not been as great as in the past. It's just been harder. Maybe that's true for some of you, maybe it's not, but this is my 18th year in the business, and it's probably the most difficult environment I've seen in terms of actually being able to find decent businesses that are materially undervalued. So just a quick show of hands, I'm curious in this group. So how many of you guys use screening as part of your idea generation process? I know I do. All right, so half. And I think there's nothing wrong with it. I think the benefits. So why do we use screening? It's it's objective, it's fast, and it's broad. So it's easy. And I think that those are legitimate reasons, and I use it as well. I think there are limitations, and I think the two limitations are that you miss things. So you miss things that don't screen well, and sometimes they're probably the more interesting things, because screening has been more and more commoditized. I've been pitched by many people who are talking about AIML, which is an acronym for artificial intelligence, machine learning, who are trying to do everything by computers nowadays. So I think there's got to be a better way to supplement screening with other ways of finding ideas. Obviously, events like this one is one. But I'm going to talk about 5 ways to systematically look for what I call hidden profits. When I say hidden profits, I'm talking about where the current profitability doesn't adequately reflect the real underlying profits of the business. Because that's where, if you do a pure kind of simple screen, that's just not going to pop up. And so the five patterns, cyclical businesses, turnarounds, the good business, bad business combination, You have good businesses in investment mode, and then you have early stage but proven businesses. So I'll talk about each one. I'll give an example of each, either from current investments making or from my past investments. So starting with the cyclical businesses, because it's probably the easiest, and it's where I started when I started my career at Fidelity. I was a cyclical analyst. And the thing you have to get right with a cyclical business is two things. You have to make sure that the problems are really cyclical. So if you make a mistake and you think the problems are cyclical, but in reality they're structural, there's decline in the industry, competitive dynamics are changing, the value chain is getting worse, that's a big mistake. So you're just going to get that wrong. The other thing you have to get right is you have to get roughly right the approximate level of mid-cycle profitability. So what's going to make the profits improve? In cyclicals, it's easy, it's time. So if you're right, and it's a cyclical business, all you have to do is wait, and then basically the profitability gets restored. And I think you make sure that you buy at a very meaningful discount to intrinsic value. And then the beauty of it is, it doesn't matter to a degree how long it takes to play out. A lot of times the common view on Wall Street is you want to wait for the turn. You want to wait for improvement. And actually with cyclical businesses, you don't. And the reason is, most cycles take anywhere from 6 months to say 30 months to play out, kind of a broad range. The compound annual return you're going to get if you buy the company right is going to be attractive at either end of that spectrum. So let's say you buy a business for 50 to 60% of intrinsic value, and that value hopefully is increasing over time and certainly not decreasing. If you make your money even in 3 years, you're going to have a 20% plus CAGR if you're right. So I think as long as you believe in your analysis, you should not wait for the catalyst in this case, and that's how I think you make money. You do your analysis, you buy, you use your time horizon as an advantage. So here's an example. This is a company, I purposely hid the name, I kind of changed the years. And I guess where I would bring your attention is the highlighted part of the chart. The earnings right now, or in the current year, are 0. So if you're doing a simple screen, and the PE is very high, even if you're looking at free cash flow, it's not on the screen that's very attractive. However, a few years ago, the company was making, it's a $15 stock, it was making $1 and over $1 in free cash flow per share. And interestingly enough, it's had very high returns on capital, very high organic growth for a very long period of time. So the question we're trying to answer here is this dollar going to reoccur, and is the company going to continue something similar, not necessarily the same, as its prior historical track record? And so just kind of to unveil it, the company was a company in the US called Robert Half. It's a very good company. They focus on temporary staffing in the professional space, catering to small businesses. And it's an investment I recommend early in my investment career, where incidentally Wall Street was saying at the time, they'll never make $1, it's very different this time. They couldn't explain why. It just was scary because profits were declining, and that's where temperament comes in. You have to look at the facts. It's a very cyclical industry by its nature, and there were no signs whatsoever that structurally anything has changed. So that's kind of a simple example of a cyclical company. So turnarounds. Turnarounds are tougher because cyclicals are just a matter of when. If you write a cyclical company, it's going to turn. Turnarounds don't have to turn. Not only do they not have to turn, most of them don't turn. It's very hard once you take a business which is trying to turn itself around to actually turn around. And there are many reasons for that. I think some of it's cultural, some of it's structural. Sometimes the businesses that are in distress are tougher businesses. Not always, but frequently it's the case. So I think you have to do something different other than just to buy it when it's cheap. Because if you're going to buy it when it's cheap, you're going to probably you're going to ignore the base rate probability of the turnaround turning, and you're going to be overly focused on the upside, and you're going to have a lot of your investments just not work out. So in this case, I think you want to see signs of improvement, but the key is in what? Because if you wait for profits to turn around, it's going to be too late. People are going to recognize the turnaround, and the opportunity will largely be going away. So you want to look at key performance indicators that precede improvement in the underlying profits. So things that are not on the P&L or the cash flow statement, but leading indicators. So you want to understand the turnaround plan. Usually it's a 3-year process. A new CEO comes in, He spends some time surveying the situation. He lays out a plan. He starts to implement the plan, and then results either take or not. So that phase when he's implemented the plan and their early phase of results, if you understood what success should look like, you can sometimes have an edge. So here's an example of another company. At the time it was a $5 stock. Its current profitability is again nothing. But it used to earn 80 to 90 cents in earnings and free cash flow. Now it's a turnaround, and if it can achieve that profitability at $5 for a company that can earn $80 to $1, it's going to be very attractive. The question is, can it come back? So the context is that the reason the company went from earning close to $1 to nothing is new management came in, they changed the sales force incentive plan, and basically people left. The key producers said, we don't want to work for this plan anymore. Sales declined. The company had very high fixed cost structure, so the operating leverage was high and profits evaporated. And what happened next is a new CEO came in, and his turnaround plan was very straightforward. He said, well, I'm going to change the incentive plan back, and I'm going to actually go and recruit back the big producers, the sales force, essentially. So it's pretty much as simple as a turnaround plan as you can have. And the question is it going to work? So the way that it's going to work in the P&L is you're going to hire people first, right? So costs going to come on the income statement, but no revenues. Because even though those people know the company, they still need to ramp up, reestablish a relationship, make calls, and so forth. Then you're going to know if it's working, because each salesperson has a certain ramp that they should come up over a certain number of months and quarters. However, if you're seeing success as the CEO, you're going to hire more salespeople. So you're going to test this, you're going to hire a cohort, and then if it's working, you're going to basically hire more. And again, the P&L is going to be still not showing signs of profit improvement because you're hiring more people, and that's depressing the profitability. So if you know what to look for, it's really are the early cohorts showing that basically they can still produce the same ramp in production of sales. Once the answer is yes, it's highly likely the turnaround plan is working, that basically the problem was solved and the reputation of the company wasn't damaged, its competitors haven't permanently eroded its competitive position, and so forth. And that's where I made the investment, and I think it's, history showed that they were able to more than recover their profitability over time. The company is another staffing company at the time called On Assignment, which was in the healthcare space. So good business, bad business combination. So this one is interesting because usually there's two or more different businesses, and one is good, the other is bad. Obviously that's an oversimplification, nothing is good or bad. But the best way to explain it is, let's say you have a company that's earning $1, but within that there's a business that's earning $2 and another business that's losing $1, right? And the combined profitability is $1, but they're two different businesses, and essentially the market is ascribing a negative equity value to the money-losing business. So if that business can be sold, shut down, turned around, anything where that dollar becomes zero, now you're going to go from a company making $1 to a company making $2, and usually the company is not, the stock market doesn't reflect that, right? So if you can buy that, I'm going to make it up, if you're going to, let's say maybe the market is valuing it as a typical company at $14, $15, because they think it's $1 of profits, if all of a sudden that dollar becomes $2, you just bought a very inexpensive equity. So I think that you want to look for situations where you can structurally exit the business, meaning some businesses, the exit costs are too high, whether it's regulatory or you just can't shut them down for some reason. But as long as you can exit the business, that's kind of important. And the other thing is alignment. You want management to have a lot of skin in the game. Usually I like to see direct stock ownership, to be honest, and you want them to be motivated to improve things. So I think that is essentially the components. I don't think you need to have the catalyst of an announced spin or sale. I think it's tricky because in the ideal world you would wait for that, but in practice that's what the stock price is going to move as well. So as long as you think you have a situation where structurally you can shut it down and management that's incented to do so, I think that's good enough for me on average. I think it's going to work out. So interestingly enough, this company has been mentioned by Max earlier. It's Go Ahead Group. It's so I figured, what's the probability of two people talking about the same small cap British company, in one event? I don't know what the a priori probability was, but here it is. So it's a company, and it has been an example of a not so successful investment for me so far, because I don't want to just cherry pick things that have worked, because obviously, at least I make plenty of mistakes, and it's a batting average business. But as Max mentioned, the good business here is the buzz business, where it's very sticky market share. The market share in the London business is very high, and the company has a very, very strong competitive position. And the bad business is the real business. It's basically you bid, a bunch of people get together and bid with for the right to a franchise. So it's terrible. It has all the classic winner's curse economics, where the guy who wins has to basically deliver flying trains that are going to magically appear at the destination, because that's how you win. You tell the government it's going to be amazing. And then, lo and behold, the unions say, well, we don't want to, have these magical trains that go faster, because maybe you need one of us per train instead of two of us, so we like the old system better. And that's kind of, there are all these barriers to actually delivering. So that's what happened to them. They've had a pretty bad union situation in one of their contracts. All the focus was on the bad business and the real business. And that's how I got involved in the stock, which I was trading at double-digit free cash flow yield at the time, with a fairly healthy balance sheet and a sensible CEO. I think so far, you can't read this, mostly can't read this, but this was my original kind of value range. My base case value was in the low 30s when I initiated this investment, and this was a little over a year ago, in early 2017. And the stock was in 17 and 18 pounds or so at the time. So it was basically trading at 50% of my intrinsic value estimate. The investment has not been working out so far. The challenge has been that the business that I perceive to be the good business, the bus business, has been underperforming. It's basically had flat organic growth, and some of it could be structural. So there is some argument. There's a certain number of trips in the UK by buses declining. Ride sharing is a structural threat. I knew that, but I didn't think the magnitude was going to be sufficient enough. So far, it's to be determined. It's too early. My typical holding period is 3 to 5 years, so I'm not ready to throw in the towel. But my value estimate has come down to the mid-20s. I actually sold half of my position when the stock got into the 20 range very recently, but I still have a small position as the stock has pulled back, and now there's still a meaningful discount to value. I think the lesson here for me is that if you're going to do the pattern of good business and bad business, you got to be right on the good business. You can't be wrong on that. So far, I've not been right. The other point I would mention is that the stock has been roughly flat, which is certainly not a great outcome, especially in the rising market. But I think it's one of the points behind margin of safety, is that it allows you room to be wrong to some degree and still not lose money, because we're going to all, I don't want to speak for all of you, but I know I'm going to be wrong, and so when I'm wrong, the idea is not to lose too much in permanent capital. So the fourth pattern is a good business and investment mode. So sometimes you have investments that are in growth capex, as we'll talk about. Sometimes you have investments that run through the P&L, and it can be a great situation where you have a company that is investing with high returns on incremental capital, with a management team that's aligned and motivated and competent, but as a result, the accounting profits are depressed because it's running those investments through the income statement. So you want to, again, look for alignment, because there's there's investments, and then there's companies just having a bloated cost structure, and you want to make sure that there really are investments with a very specific incremental return on that capital being committed. Essentially, when the market penalizes companies for that, what it's doing is giving assuming there's going to be a negative return on investments, right? Because, again, let's say you have $2 of profits underlying, but the company is taking $1 and putting it back into growth projects that will pay off in 3 to 4 years. If the market treats the company as if it just has $1 of profits, it essentially is saying that money is being thrown away. And the possibilities are many, but one possibility is, let's say the company realizes that it's making a mistake, and then it can shut down those investments frequently. So either way, you're going to have profits increase either from returns on those investments or from the investments declining if they prove to be unsuccessful. So here's an example of a recent investment I made that fits this pattern. It's a company called Mishuris. It's a Dutch-listed company. It's in early 2017 when I made this investment, basically according to Bloomberg, they were making just north of $4 a share, and the stock was in the low 80s. And the company has had double-digit organic growth rate for a long time. Excess return on capital. You had a founder CEO who had over 100 million in equity. So fairly compelling alignment kind of history. My range of what I thought was normal EPS, so if you strip out growth investments, was in the $5 to $11 range with a base case kind of in the mid-7s. So a very different number from the $4 to $4.50 that kind of the market was using to value the stock. I'm not going to go through all of these, but management was actually very good about outlining specifically what the investments were, why they were making them, and what were what basically the goal of them was. And so you could pretty clearly see, I can maybe pick one. They were investing in something called the mass customization platform. By the way, the company prints business cards and has, their business model is to take, to print customized products at scale, or make customized products at scale. So if you have a business card, there's a pretty good chance that they or one of their competitors printed it because they can do it more efficiently than a small local printer. And they do other things like pens, signs, and so forth. So they were trying to build this business called MCP, Mass Customization Platform, which was going to have economies of network. They were going to basically connect various companies that were on the marketing side with various fulfillers who could manufacture that, and they were going to sit in the middle and create a very big moat. And that was very attractive. It was very early stage. It was almost a VC-like internal investment where they were trying to build a new business model within their corporate structure, and they were spending $25 million or so on that. And so far it's not been working out. The point is there was a bunch of money being spent in the P&L that even if this fails, was going to go away. And I think that's important to understand analytically, and the market wasn't really treating it that way. So again, you probably can't see some of this, but my value for the business was well in excess of what the market was pricing. It was about $160, almost twice the low 80s where the stock was trading. And so far, the market quickly, kind of after a few quarters of good results, and an analyst day where management again highlighted the investments and why they were making them and quantified them, the stock revalued fairly quickly, where I still have a small position and I think it's moderately undervalued, but certainly not as compelling as it was initially. Finally, the last pattern is an early stage proven business. And I think proven is important. There are plenty of early stage businesses, and if you go to Silicon Valley, there are plenty of people who can put up a chart with they have 1% of a giant market, and if only they got 5%, they're going to be huge, and give them some money. That's wishful thinking. So proven is meaning like some of them will be Amazon, the vast majority of them will be asking you for more money for a different business model in 2 years, right? That's how the business works. So it's very important that when I say proven, I'm not talking about a public market VC, basically startup, which is just trying to raise VC funds in the public markets. I'm talking about a business that has a history. Because obviously the base rate probability in early stage businesses is poor, and that's offset by kind of the power law distribution that the winners are huge, right? So that's kind of how it works. But if you're trying to assess any one company that's early stage and promising, the chances of success are not particularly high. So you want to look for a business with a strong competitive advantage. You want a proven track record of gaining share in that addressable market and a long runway for growth. And this is important. I guess the fourth point is evidence that they've gone through their scaling issues. A lot of times the organization doesn't scale beyond the original founder or beyond some unit. Let's say it's a retailer that's going from one region to many regions. And I think once they've gone through the growing pains, that's when I think of them as proven. And obviously you want a superior culture, because I think one of the things that makes these compounders compelling is they have a culture that just attracts like-minded people and repels people who think differently. So a recent example of this was Commerce Hub. It's a little niche company. It was a John Malone spin-off. So John Malone loves doing these complicated financial kind of, engineering transactions, and otherwise life is boring. Just operating businesses and collecting cash flow is not that much fun. You got to do something different. And so Commerce Hub was founded driven startup 20 years ago which did something called drop shipping. So drop shipping is if you order from a retailer and they don't actually have inventory, but instead their supplier just ships directly to you, but to you as a consumer, it looks like the retailer sent it to you. The shipping material is the same. The bill of goods in there has the retailer's branding. So it allows the retailer to have a very long tail of inventory, just like Amazon does, without actually holding inventory. So the logistical process of handling that, tracking it, making sure that you have everything delivered on time, and that customer service from the retailer can still help the customer if there's any issues, even though they didn't actually physically fulfill the order, was called drop shipping. So it's a very, so e-commerce obviously is still very underpenetrated, and within that, drop shipping is actually even lower in terms of penetration. You have the founder CEO who spent 10 plus years here with 10% plus organic growth. They had dominant market position, likely 3/4 market share with this fairly narrow niche. And they had spin-off accounting obscuring their accounting income statement just because of how stock options were accounted for in the US on the GAAP. So again, a little hard to see, but here kind of my underwriting at the time when the stock was in the $16, $17 range, and I thought the intrinsic value was high 20s, 30, based on what I thought was very reasonable as far as increased penetration, that they already shown for a decade that the penetration has been consistently climbing, and this continuation of that. Importantly, I did, this is where I think you want to do a fair amount of primary research. So I spoke to two customers, Walmart and another large retailer, just to understand switching costs. So why can't the retailer do it themselves? And it turns out it's very difficult and it's not worth their time, especially because the fee is tiny. So it's a classic specialty service where the fee is small, but the benefit is large. And also, again, because of the switching costs, and the low price, it just doesn't make sense to switch to someone, unless there's a problem with the service. The only way you would switch is if you thought, your customers weren't happy, and in this case, the customers were happy. So I thought, very dominant competitive position in a niche, a lot of penetration, big addressable market. So basically, somewhat unfortunately, I would say, in this case, the company got taken private by a private equity group. I say it's a little bit unfortunate because I don't see what the PE guys can do in the private markets in this case that we couldn't have done in public markets because there was no debt. John Malone is very comfortable with leverage. So perhaps they had a different view on the value of the business. So it was a modest return, about 30%, which is not terrible. But in this case, I would actually prefer they compound in the public markets, and I think we could have benefited a little bit better from their upside. So anyway, just to wrap up, I think that all of these are situations you would have missed if you were purely screening, especially kind of very, very simplistic screen. And even if you were trying to come up with some really sophisticated screen looking at longer historical data series, which I try to do, you will still miss a lot of these. So I think it's certainly a supplemental way of looking for where are there profits that might not be showing up in the current accounting statements. And not all of those, but some of them could be great ideas to pursue further. So that's it. Happy to take questions. Questions? Comments? No? All right. Well, thank you.
Thank you.